Welcome to This Week in Intelligent Investing, where we examine timely and timeless investment topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Chris Bloomstran, Phil Ordway, Elliot Turner, and other thought-leading investors. Brought to you by MOI Global. And now, here is your host, John Mihaljevic.
Welcome, everybody, to another episode of This Week in Intelligent Investing. We have a great conversation ahead, and it's a pleasure to welcome Chris Bloomstran, Elliot Turner, and Phil Ordway this week. Each of them has prepared some discussion on an interesting topic. We'll start with Chris, then we'll go to Elliot, and finally we'll have Phil, who will do an interesting thought experiment, a sort of a quiz that everyone can participate in while listening to the podcast. And I think that's going to be very interesting. So please stay tuned for that. But first, I'll go to Chris.
Yeah, thanks, John. Well, I think we've had some terrific conversations over the last few weeks getting this podcast up and running. And we've spent some time on governance, which has been terrific. I thought what I would do this week is take a company from our portfolio, Starbucks, which we've owned really only since 2018, but I've followed for a lot of years. And, kind of from a portfolio management lens, kind of take a business that's not black and white. And I think the reality is in investing, very little is black and white. So, with Starbucks, you happen to have this collision of, I guess what you'd call valuation, governance, which we've been talking about, capital allocation, and even business fundamentals. And full disclosure, Starbucks is a big position for us. It's top 5 on the order of 5% of our capital. Like I say, we've owned it since 2008. Made a huge mistake of not owning the stock during the financial crisis and the meltdown in 2008, 2009. The stock traded down to, I think it was $4 a share. So it traded at less than 1 year's revenues. At the time, they were doing a 9 or 10% profit margin. So it was really cheap. But everything else was cheap. And so, I did not jump on what I, knew to be a business that had a very long growth curve. So sitting here today, with a business that I still think has a very long growth curve, a few things have happened. Coming out of the financial crisis, the stock ran straight up. And by, I'm going to say 2015 or so, the stock had traded up to about 40 times what the business earns, which was really expensive, and then spent 3 or 4 years in the penalty box. They had some issues with fundamentals. They were starting to get cannibalization in various of their North American markets to a degree, although I still think the business can grow units in the United States and North America at a decent clip over time, and we can talk about that. But, the stock traded sideways, the business continued to grow, and, we were able to come in and buy a fair position, and it was a case, we talked about the process of putting capital to work and position sizing. We came in with a big position right out of the gate, paid a little under $50 a share. And here we are today with the stock trading at $88. And so we're back to, a multiple pushing 30 times. The stock is trading at kind of 20 times operating earnings. So we have valuation concerns. I wouldn't be a big buyer. We've bought it, 10 points lower for cash flows and for new clients. In fact, just a couple of weeks ago, the stock's up, $11, $12 just in the last 2 weeks. And, I think the case for the business really hinges on long-term growth. I think it's a company that can grow its top line at high single digits per year with, modest, reasonable share repurchases. You can grow earnings per share kind of at 10 to 12% perhaps. But if you go back a couple of years when Howard Schultz stepped away from the business and Kevin Johnson came in as CEO, he came in from Microsoft and he'd had a couple other tech jobs. And really almost immediately with Schultz leaving the business, the company at that time, for various reasons, ramped up what had been a pretty aggressive share repurchase program. And, this kind of gets into your capital allocation and governance. If you go back 10 years, generally the share repurchases, which ran on the order of 20 to 30% of profits per year, were really in place just to offset the dilution that came from share issuance for restricted shares and stock options. And then starting in 2016, when Kevin became president, 2 years later, CEO, they really ramped up the repurchases. And if you guys remember, in 2018, the company, which had previously ditched a distribution agreement with Mondelez, signed a big deal, a $5 billion deal that they were paid cash on the barrelhead for kind of coffee and some global distribution rights. So with that $5 billion, the company went out and really ramped up the share repurchases. And they bought, over the course of a 2-year period of time, on the order of $17 billion worth of the shares. Took the book value from $5 or $6 billion down to a negative $8 or so billion. Borrowed a fair amount of the money that was used to buy the shares back. Spent on the order of 100 to 250% between those 2 years on buying back the stocks. So now you have a company with no on-balance sheet book value. They've leveraged up the balance sheet. I think you can make the case that, and maybe it was just coincidental, but when they did the Nestle deal, it was the time that we were buying the stock, and it was cheap. I mean, I think Starbucks was genuinely materially undervalued a couple of years ago. And certainly the share repurchases contributed to the rise in the stock. It traded as high as almost $100 last fall. Then it sold off during the COVID downturn, and it's almost back to where it was. And so we struggle with the valuation. You kind of think through the motivations, and Elliot, to our conversation last week, and Phil with governance issues. You go through the proxy for the last 10 years, and it's a company that had done, I think, a reasonable job with executive compensation. For a long time, they had kind of used an adjusted earnings per share metric, and at a point, they overlaid top line growth. And I'm going to say 8 or 9 years ago, I remember they threw in a return on invested capital metric, which was really just used as a downward modifier. But I'd love to see. I mentioned several times since we've talked. I love to see companies who incentivize managements with some form of return on capital or equity or assets. And so you at least had a modest modifier in place that would kind of work down if the company wouldn't hit a return on invested capital of 22%. It's risen by a few points, which makes sense because the book value has been shrinking thanks to the share repurchases north of book. So you've got to push up that ROIC metric. Again, a couple of years back, they really made a shift change and moved away from a return on capital, and just in the last year eliminated that yardstick for what has become a relative 2 and then 3 year rolling total shareholder return. So all along, the company's had a motivation to buy back the shares, did not have a huge motivation to buy back the shares at a reasonable price. And, I wonder, given the size of the repurchases in 2019, which were made at much higher prices, $85 a share versus the $50 they had paid the year before, we scratch our heads. And again, to my point, there's very little that's black and white in investing in. So we sit and watch this evolving governance. We watch the capital allocation. I think given the leverage that exists now in the business, a great time to have bought back stock would have been during the COVID meltdown. The stock traded down to $50, which was our original cost 2 years ago. And the company, like so many, were handicapped by too much leverage on the balance sheet. And the best time to have bought back stock, even though the company had closed over half their stores internationally, would have been to buy back shares. But they were already at that kind of 3-to-1 leverage, which is on the max end of where they want to be when you look at capitalized operating leases. And so you've got a business that's less flexible in terms of capital strategy. I still think, between paying half the profits as dividends, opening incremental stores, and I think the store growth in China is really the bull case for the stock. And then modest repurchases. They've got a use for what amounts to about $5 billion in operating cash, but albeit with less flexibility. And so we scratch our heads. And with the stock trading on the very expensive end, it's kind of one of these mid-range things where you're not so inclined to buy meaningfully, you're not so inclined to sell meaningfully, so you watch and wait. And you wouldn't call them red flags, but pink flags have been running up the mast of the ship. And I thought it would be an interesting conversation point, with the conversations we've had. So I'll open it up to you guys, and I'd love your thoughts on the business. I don't know if you own it, but certainly some of these governance and capital allocation issues that are so pervasive everywhere that even in a great business like Starbucks, you step back and wonder if they're really doing the most intelligent thing.
I've looked at it, and then from that lens, I would say it always struck me as a pretty well-managed company. And I agree, there's some imperfections that could be improved for sure, but nothing that would scare me away, at least relative to every other large public company that's out there. I mean, I was just pulling up their stock-based compensation number, like you said, that did used to be a pretty meaningful number. They're just offsetting. It's less meaningful now. So yeah, I don't think there's anything there that would really scare me off. I'd be curious for your thoughts, though, as to how much the international growth is going to be the determinant factor in the future, and how much you think they might have room left to grow in the core markets where they already exist. I mean, I know they've had great success expanding in places like China, but I'm just not much up to speed into what the odds look like for that going forward.
Yeah, I think, the North American market is certainly far more saturated than it was, but you've seen them in the last few years continue to open U.S. stores at a 3 to 4% net store count clip. They're opening stores, but they're also closing stores, but that net number grows by 3 to 4. I don't see that changing for the foreseeable future. The real growth in the business, and this has been evolving for the last 5 years. I mean, to me, China is very much a Starbucks story. It looks to me a lot like Yum Brands and the chicken business a handful of years ago when they really started rolling out in China. The unit economics in China are better stores. They have about 4,500 stores today. I think it's entirely plausible that 10 years out, they've got as many stores in China in the system as they do domestically. So putting it all together, the system has about 32,000 stores, roughly evenly split between company-owned stores and effectively your lease stores, your licensed stores. Some are actually, a few are still run on a pure franchise model. All of their stores in China are company-owned. They used to have a joint venture that they effectively bought back. And so Starbucks owned the store. So the bull case is they can open stores at a mid-teens rate of growth. I think, 1 to 3% type, same-store sales growth in terms of revenue comps makes sense. I think they can drive numbers of transactions in their global franchise and even in the U.S. stores. They had some issues. Part of the reason why we were able to buy the stock is they had some operating cash flow issues. The stores had gotten too crowded. They didn't really know how to deal with the online ordering. And you wound up with a point where the stores were really understaffed for high volume traffic. You didn't have enough warmers for their hot food items. So they've solved a lot of that. They've had to actually increase the staffing during peak hours. The line of walking into a store and waiting, it was a frustrating experience when people are walking in who had pre-ordered on their phone their order and they're picking up their coffee, and you're standing there for an extra 5 or 10 minutes above and beyond what had been the case 5 or 6 years back. So they've worked through that. Their blocking and tackling is really good. But I think, that growth curve in China is really long, and which also becomes the biggest risk to the business as well. And it's not so much that a Luckin or somebody else can come along. Luckin wound up being a fraud, but that was always kind of conventionally in the last 2 or 3 years perceived to be the big threat was delivery. Well, they've got a delivery business in China. They've got a partnership with Alibaba. They lean on mobile pay in China far, far, far more than they do in the U.S. And it's a big deal in the U.S. It's the mobile orders is about 40% of the rewards points are about 40% of the business. It's closer to 75% in China. Throughout the rest of Asia, they can grow. They've proven not to be able to grow that much. To your question, Phil, in Europe, I just think the Starbucks cafe model doesn't hold up against mom and pop cafe model. It's a different animal in Europe, but in Asia and in various of your emerging markets, there's still I think a very long growth curve. And the risk would be that we wind up with a much worse relationship with China and the CCP, and you wind up seeing what's happened over the course of decades. Foreign governments commandeer your assets, and all of a sudden, they take your stores away, they take away the right to grow in the country, and the long growth tail winds up being greatly muted, because without the Chinese growth tail, Starbucks is not worth the current multiple to the current earning power on the business.
Yeah, I gave a good hard look to Starbucks in the first half of 2018. I was very close to buying it on the earnings where they basically said, store level growth, same store sales had come in, but they're going to go about this project of cap structure optimization. And, when they really ramped up the repurchase. I found several things interesting. I mean, I tend to look for GARP type situations. And to me, that whole move for cap structure optimization was an acknowledgement of degree of maturity, that they had kept an overcapitalized balance sheet for a long time, and they were no longer going to do that. There was a bit of a signal that they expected growth to slow. At the same time, it was when they had purchased and kind of recaptured the rights to all their China stores and growth in China, and it was a pretty complex transaction that part of the world where I can't quite wrap my head around the opportunity as well. Like, I understand it's a huge market, but I've always had these fears of, can US investors ever realize the fruits of that opportunity? Like, will the cash even ever make its way back here if these businesses could continue to operate unabated over there? So, I had a hard time with that. The things that really intrigued me when we were in Idea Week 2019, Isaac Schwartz presented kind of like this thought experiment about a WeWork type place where people go and sit and get their work done, and the price is fairly small, and you could go and do it anywhere in the world at a place that's similar, trustworthy. You know what you're going to get, and the idea was that it was Starbucks at the end of the day, and it was definitely a way that Starbucks resonated with me. I end up going to Manhattan. I call it the city. I go to the city a lot from Stanford, and I often needed a place to plant myself, and I would find myself at Starbucks pretty regularly. And then the app using Pay, that was really intriguing. And I like it. I should have stepped up the price I was holding firm to, which was in the mid 40s. Never quite got there intraday. But what I'd ask about now is, I wonder if people's behavior is changing in a way where, they got themselves a coffee grinder, they have a subscription to high-end beans that come to their house monthly. They have a drip coffee maker, have taken a certain joy in doing it themselves at home. And, who knows what happens with office space down the line? Do we end up going as much? Like, if people aren't going into the office as frequently, Starbucks was a common break spot. You'd step away, go down, get a coffee, and, kind of in some ways the modern cigarette break. So like, what happens to Starbucks going forward? How can they evolve, and how do they find and make sure that their role is as relevant going forward? That would be what I'd worry about today. Curious what you think.
To me, I think they've solved a lot of that, and you've seen it in the COVID. I mean, obviously, when you close half your stores, they're back up to now where they're 95 or 96% of their U.S. stores are open. They're almost fully open in China. The closures and the store growth decline really was much more modest in China than it was here. With half the stores being licensed, you just don't have the same volume of traffic in airports, for example. So their licensed stores at the end of the last quarter are only about 87% open. But I think you've got the traffic. I think what you've seen is they're driving larger transaction sizes. So the mobile orders are larger. So if you're going to wind up permanently working at home, and I'm not sure that's a massive permanent trend. I think once we're clear of the COVID, a lot of people are going to leave their white collar home office space and head back into the more conventional office space. But the revenues have improved markedly. And, you're still taking your kids to school at some level for those that are allowed to be in school. And so you run out and you get your coffee in the morning. Instead of going to the office, you bring it back home. They've got a delivery business with Grubhub where transaction volumes are really high. So I don't think the changing culture is that much of an issue. They've cultivated this great affection for the brand. They've cultivated an affection for the product. I think the Nestle deal was brilliant. To your point about your home grinders and what have you, the deal with Nestle gave them global distribution. I can tell you, during the COVID, I started drinking coffee again. We have an espresso machine, which is wonderful. And the Starbucks pod that goes into the Nespresso machine runs about 65 cents per canister. We get them at Costco. So you can get 60 of them for, I want to say, $39. And the quality is terrific. It's in a pod, but you get the same foam on the top of the coffee. My kids will still, because they like to drive, they'll leave the house because they like going into the stores. But really, you get into this curve in China, and there's such a devotion to brand by the Chinese, all the way up from a Patek Philippe watch all the way down to the kind of the green logo on the Starbucks cup. And the Chinese palate has proven to like the roastery, to like the flavor of the Arabica bean. They've actually developed their own roastery in China to suit the Chinese palate. And you look at the numbers, and the average Chinese citizen, and there are a lot of them, consumes 1 serving of coffee per year versus 200 servings of coffee per year for every man, woman, and child in North America. So if you believe they can grow from 100 plus cities to 250 cities, and they can get into more of the smaller city suburban core, I think the growth curve is wildly long. And if you're looking at 32,000 stores today, it could be really long. But I think they've become too much of an embedded part, Elliot, of the culture, to where the brand is as recognizable as anything, and the product is outstanding. And they're really good at blocking and tackling. And so they've worked through the issues in the past. They've had the issues with the line that I talked about. I don't think a changing home culture is going to impact the business that much. I think it's going to drive transaction sizes higher. And I think baking on a 10%, say, top line growth, combined from unit growth and same store sales growth, is a reasonable assumption for the foreseeable future, which means even at $88, the stock is not wildly expensive. It's not trading at 40 or 50 or 60 times. It's trading at a kind of mid-20s multiple. And if you believe the growth curve and the units, it's not that far away from being as great of a buy as it was 2 years ago at $50 a share.
Yeah, I'm with you. I think the two things that I've missed over the years that are the most important things in these types of situations are what you just highlighted, which is, I'm with you, by the way. I don't think everybody's going to work from home forever. There's going to be more flexibility and maybe some de-densification of some of the big urban centers, but I don't think that really impacts things here. I think the China thing is much bigger. But anyway, I think the habit-forming nature of the company and the McDonald's effect that you saw in fast food is really what's relevant here. And I think Howard Schultz has talked about this quite a bit, that he wanted to replicate that cafe kind of setting where you did have somewhere to go, like Elliot was talking about. We've all done this, I'm sure, when we're traveling or in a new place. But it's also just a very significant part of the daily routine for a lot of people. And so those two aspects, I think, are hugely important. And then the third one that jumps out at me is, I still remember this right out of college. Our freshman banking class in New York was had one of those kind of well-known finance and accounting and valuation experts come in to do the training. And he actually used Starbucks as an example. And this was unfortunately a long time ago, but he told the story about how his wife had actually come to him, I guess it would have been in the mid-90s, and said, honey, we should really look at this company. I think this is going to be the next great thing. And he looked at it and basically looked at the financials. And like a lot of us are prone to do, the financials back then were still a little bit of a mess. And he would have had to squint to kind of imagine these qualitative aspects really taking off. And he said, kind of shoved her to the side and just said, look, honey, this is ridiculous. We're not buying stock in this company. This is a joke. And everybody got a good laugh out of it. And we're all sitting there going, wow, our, vaunted professor at the front of the room doesn't know what he's doing, because he's up there saying he missed it. But of course, one, that's a very easy mistake to make that I've made several times since then. And of course, he made another mistake, which I've done over the years a lot too, which is to say I missed it. And so he hadn't missed it 20 years ago by any stretch of the imagination. But here we are. So I still think about that all the time when these combination of factors pile up in a business. You really just need to get those 2 or 3 things right. And it doesn't matter if you miss the first part of it or even the first 5 or 10 years. There's still a long, long way to go.
Yeah, and even if unit growth doesn't wind up being the 6 to 7 or so % that the company forecasts, again, they've still proven an ability to grow in the United States, which is remarkable. And these units are unbelievably profitable. Each store does $750,000 in revenues. The U.S. stores are in high 20s return. The cash investment to open a store is only about $300,000. Starbucks does not go out of their way to let you know how profitable their Chinese stores are. But if you look at the incremental growth and returns on total capital employed in the business, it's easy to get to maybe a low 30s number on these Chinese stores. And so, if you go to the worst case and the Chinese commandeer those assets and there's no growth curve, it's 4,500 stores out of a 32,000 store franchise. It's not huge yet. That would be an extreme worst case. But they can grow in Japan. They can grow throughout the rest of Asia. They can grow in emerging markets. And at those unit returns on capital, any store you can put in the ground is incrementally profitable. And you've not seen really the point, even kind of in 14, 15, when they ran into cannibalization in some locations. Their real estate people are really good. And so they know when they're cannibalizing each other's stores. But the ability to still grow unit stores in the United States is remarkable, because all of us would have said, or at least I would have said 10 years ago, no way, they've completely overdone the US. And all of this growth is going to come internationally. If you look at the numbers, if you look at the unit growth, they can still put shovels in the ground and they can still open units, which is remarkable to me. So I think, even at 3 or 4% unit growth, kind of half of what they're baking on, as long as you can drive the comps up 1 to 3%, 3 or 4% in the US, it's still up. It's still got a great growth tail to it. And you're not paying a high tech or a software type multiple for it. And the incremental unit profitability is off the charts.
Yeah, it's hard to disagree with the general thinking there. I mean, I definitely don't think work from home is going to be permanent. I do think maybe the 3% range in store comps is a bit aspirational. When I was working on it in 2018, they were slowing to, flirting with negative. Obviously, it was the restaurant recession time. There was some pullback on their strategy on the food side of things that they were selling alongside coffee. But it seems more like the 1 to 2% range. So if they do 1 to 2%, add 5% to the store footprint a year, mid to upper single digit growth, doesn't seem like they could wring much more margin out of the US stores. And then I guess I'm just really trying to play devil's advocate here because I'm pretty freaking intrigued still. But to throw out a comp on the cap structure side of things, Bed Bath & Beyond, great company, great growth, similar recipe. They were pushed by Dan Loeb to kind of maturize their cap structure. They took on a bunch of debt to repurchase shares, and a slow deterioration in the business kept them hamstrung strategically from more forcefully moving into a new direction. Not to say that potential exists to the same extent at Starbucks, but I got a whiff of you with some concern about where they left the cap structure and how that kind of left them with their hands tied behind their back during the COVID shutdowns. What do you think about those points there?
No, I think you're right. And the big red flag to me was the very large share repurchase in 2019. Again, I applaud them to no end for the $7 or so billion that they bought back in 18, because they bought them back at the price that I was paying. But then when you paid $85 a share, which was kind of back to a 30 type multiple to normalized free cash margins, it was a big number. And to me, I want to see a share repurchase done at an incrementally attractive price and not so much to buy them back for the sake of buying them back. And so when you encumber the balance sheet to the point where you reduce some operational flexibility, it's problematic. So I would watch something like that. To me, there are enough pros to offset some of the cons, but it's a comp heavy structure. Why Howard Schultz was granted as many option shares as he was, even very late in the game, was a mystery. Obviously he was a rock star and he built the brand and he grew it from nothing to a absolute colossus. But yeah, it's allocation and governance are more of a lukewarm concern. Yeah, Elliot, I agree, than they would have been 2 or 3 years ago. And so we watch it, and if the growth curve winds up not being a problem, or winds up being a problem, you overlay those, and all of a sudden the preponderance of the evidence points against you. But for the time being, the size of our position reflects what we think about it. But I hate seeing a balance sheet that 10 years ago was pristine. I mean, very little long-term debt. They use obviously a lot of operating leases. You capitalize those now, and like I say, they're running on the very high end of where the business should run on a debt to EBITDA basis, and it takes away some operational flexibility. Now you can make the counterclaim and argument that, well, there's not a lot of use for the capital. I mean, you're growing as fast as you can. We're going to grow units in China at mid-teens rate. We're growing every store we can. We're leaning on our license partners to the degree we can. We've done good things with consumer packaged goods. And so maybe there's not a lot of use for the capital. So, and you see that in the dividend policy. You see that in the dividend policy in companies like Costco, which have kind of increased the payout, and they've done it with special one-time dividends. But 20 years ago, 10 years ago, Costco needed the capital to grow its units incrementally. And now the unit growth is smaller as a percentage of outstanding stores. So of the $5 billion in operating cash flow, pay half of it to me as a dividend. That's okay. As long as you can still drive incremental returns, at least neutral or higher with new stores, you will. I don't know. I'm going to say it for like the third time, but a $10 billion share repurchase, which was almost 2.5 times the net income for year 2019 to buy back stock at prices that I would not have paid, gives me a little bit of pause.
And Chris, just a quick question on how the stores are actually operated. Are those company-owned stores for the most part, or do they also franchise?
No, it's about half. About half their stores are company-owned. So call it 16,000 stores are licensed stores. And most of their licensing partners are really good operators. So when you go into a Starbucks store in a Target or in a grocery store, those are managed by the operators there. When you go into a Starbucks in an airport, those are all run by HMS Host, and they run several hundred of their licensed stores and travel plazas as well, again by HMS Host. So the license partners that they have are terrific. So the business will effectively make a margin from the licensed stores for any of the branded products that they sell. They also get a royalty stream. And then, like I said earlier, a few of their stores are under the pure kind of classic franchise model. But generally on those licensed stores, the gross margin to the parent is less, but the operating margins are huge because, again, the company's not bearing the capital of the lease. And so, the incremental profitability driven by their license partners is terrific. And they're not going to give a license to anybody. They're giving them to very, very good retail partners. So the economics are different, and it's kind of hard to tease out the implicit unit store profitability. We've tried to do it over the years, and I can't tell you exactly what a unit looks like between a franchise store, a licensed store, or a company-owned store. But again, if you assume it costs about $300,000 to open one, and that's the cash cost without the real estate put in, the break evens for opening a store are about 2 years. There's something like 1.5 years in China. So I think you'll see, probably a little bit of drive toward company-owned stores. Again, all of their stores in China for the time being are company-owned. And so with most of the incremental growth coming from China, the skew is going to start, I would guess, moving that number up a little bit off of 50-50, but it's about half and half, John.
Got it. Great. Well, I guess we'll leave it there for Starbucks. That was a great discussion. Thank you, guys. Let's move on to Elliot for what you had on your mind for today.
Okay, yeah, you guys may have to forgive me or thank me for introducing this discussion. I was slightly reluctant to take this trip down memory lane at first, though I was encouraged to do so by more than a few people. And I thought it would be, both timely and interesting to kind of think about whether 1999 is an appropriate and relevant comparison for the market today. Seen a lot of people say, like, this is just like 1999. And when I sit here in my seat, I could feel myself arguing both sides of this case pretty vociferously. There was an interesting tweet yesterday from Modest Proposal, which I think drew on an empirical research piece that said, had 4 charts, but the interesting parts in particular were that today, just like 1999, the best and worst quintile of free cash flow margin companies are outperforming the rest of the market. So those with the best and the worst free cash flow profiles are the kinds of stocks that are doing the best right now. And they're outperforming by about 10% each. And then if you look at deciles of free cash flow to EV, it's disproportionately rewarding those companies on both sides. It's disproportionately rewarding the most expensive companies, the companies with the worst free cash flow to EV. And interestingly, though, it's only 1/4 as extreme today as it was in 1999 there. And then revenue growth as a factor. This is one that's interesting that I think a lot of people will really draw on. But revenue growth as a factor is outperforming the S&P at an even higher rate than in 1999. So people are really, really paying up for revenue in particular. And I think that's the constant between the best and worst quintile free cash flow margin companies outperforming as well. But then I wanted to consider like a couple other things to help contextualize this all. So when you look at the companies that are performing the best and the worst, there's some persistence from pre and post COVID. But one of the big constants is that there's real dispersion in the pain and opportunity from COVID as an external shock, right? COVID is not the economic cycle playing out in an oscillating way. It is something completely external to our everyday state. And because of this, there are factually disproportionate winners and losers. So some degree of dispersion, I think, is incredibly justified. And when you think about this from a valuation perspective, right, the companies who came into this with very low valuations, look at sectors like energy and retail, brick and mortar retail. Those are two of the sectors most vulnerable to the consequences of stay-at-home orders. And the winners on the other side of the ledger, those companies in technology are disproportionate winners. The second thing that I'm thinking a lot about and considering, retail investing, the activity is surging. There's no way around that. I think this ties in pretty nicely to our conversation last week where we were talking about payment for order flow at the brokers. Retail activity, you drive transaction costs to zero, you give everyone an app that's completely gamified like Robinhood. You make options just another toy that you could throw around, and people are playing. Especially, I guess the third dimension is you tell people that they have to stay at home. They're treating the stock market like a video game, and Dave Portnoy kind of embodies this phenomenon. Yeah, and I think it's one of the clearest ways you see that is in splits driving prices to absurd levels. The third thing I'm thinking about with this is you have rising concentration of the biggest S&P stocks. So like, Apple in particular, some of these big tech companies, they're a much bigger and bigger part of the S&P. And then, you think back about a Buffett quote from, I think it was a 2018 annual meeting. The four largest companies today by market value do not need any net tangible assets, he said. They are not like AT&T, GM, or ExxonMobil requiring lots of capital to produce earnings. We have become an asset-light economy. So these companies are like inherently different, but a degree of concentration that's higher than we've seen in a generation is something to think about. The fourth thing I'm thinking about with this all is the market was far more heated heading into 1999 than today. So in the 3 years heading into 1999, the NASDAQ had gone up by a factor of 4x in that period. Today, over the prior 3 years to this date, we're less than 2x, more about 80%. So while things are a little giddy, it's not exactly apples to apples. Sorry for my pun there. And then, the last gets to that Buffett quote, the fifth thing that I'm really thinking about right now. But a lot of these growth companies that are all the rage, that have revenue really driving things, revenue growth being the gaudy figure that people are investing behind. While it's being a little more rewarded than in 1999, by and large, and I could point to a couple exceptions, but by and large, these companies are internally financed. They're not beholden to capital markets. They don't have to rely on fundraising to drive their growth. They really could rely on their unit economics and invest incremental margin into S&M. And so, in some cases in particular, where there have been excess earnings from COVID, they could really ratchet their investment to accelerate their growth. Where, perhaps not wanting to tap capital markets was a constraint, and having these greater resources, they could drive growth. So perhaps, some of these companies truly are worth more because their runways are untapped, are very long. And the only thing holding them back was the resources to invest and a willingness to tap into them. And so, I guess the last thing to consider is if this is like 1999, how does it all resolve, right? Do we end up in a crash-like scenario where value outperforms and growth drops, bringing everything down with it because the market's concentrated in growth as a factor? Or do growthier things end up in this like decade-long sideways range of stagnation? So I want to open this up to everyone else to kind of chime in with their own thoughts, what they're thinking about in this comparison, and let's see where it goes from there.
Well, I don't know that I have any brilliant insights. I think the one thing that jumps out to me isn't whether this is an exact replica of any prior time. I think the data you suggested or pointed out suggest all the same things, which is, you're right. I mean, people are clearly paying up for revenue. Now, whether that's taken too far or not is a little bit different question. In my high level and bottoms up view of individual companies, we haven't quite gotten back to where we were in 99 or anything like that. I wasn't investing through that period though, so it's easier to look through the academic historical lens and say, oh, well, of course you missed this and this and this. It's much different when you're actually investing through it. But one thing that definitely jumps out to me is just how that did spawn the golden age, or at least the most recent golden age for value investors, that were buying things that were ostensibly cheap. And I hate that term, but it was a very good period for active managers, particularly of any variety of the value bent, for that ensuing 4, 5, 6 years, really from 2000 or 2001 through the financial crisis. And that, to me, other than maybe a 12 to 24 month window on the back end of the financial crisis, was really the last prolonged great opportunity we've had. And so there hasn't just been this, there have been some good opportunities since then in the last decade, don't get me wrong. They just tended to last weeks and months rather than years. And so I think if you look back too, I mean, the other striking thing is you've just had declining interest rates this whole time, more or less. You really haven't had a multi-year bout of market pessimism since, maybe the bottoming out of the Nifty 50 bubble in 73, 74. And so if you want to make historical comparisons, I almost wonder if that's more interesting, because there was this prevailing ethos in that era of, you don't need to analyze the company's future prospective returns as an investor, because these great 50 companies are just going to dominate the world. And that also then coincided with a period of stagflation, and you get 2 or 3 things working together that really led to some ugly results for a long period of time, and a decade plus, culminating with the death of equities kind of headlines. Again, that is not a prediction of any sort. I just think that might be an even more interesting parallel potentially, even though there's obviously some very good parallels to the late 90s as well.
Well, I think, guys, having lived and breathed that period in the late 90s, the parallels to me are striking today, and there are clearly nuances. Interest rates are a distinct differentiator. We're sitting here at the zero bound of interest rates, but it's become fashionable to talk about 99, and everybody wants to look at comparisons at the absolute peak on March 10 of 2000, or the subsequent peak later in September for the S&P 500. But it was really the tail end of that 17-year bull market that started in 1981 under early Reagan's first term. And during that bull market, we took credit levels, total credit market debt, from 158% of GDP up to what I then thought at the time was a nosebleed 250% level. GDP was 10 trillion on balance sheet. Total credit market debt was 2.5 times that, so $25 trillion. And that period from 96, 97, 98, 99, culminating in March of 2000, was extraordinary. I mean, it was a straight up for the NASDAQ. It was a brutally painful period for kind of your classic value investors, those where price makes a lot of sense. There were tons of businesses that were growing. The internet had been adopted. At the very top end of the NASDAQ, Microsoft and Cisco and Intel and Oracle and Sun, and the list goes on and on. I think people today talk about all the businesses that are real and generating real profits. Well, those were real businesses. I mean, they were growing at extraordinary clips. They were extraordinarily profitable. Microsoft, which at the very peak was doing $20 billion in sales, it was capitalized at 30 times that number, and 85 times earnings. But if you go back, and Elliot, you mentioned it. You talked about the from 2 to 5. Really, if you go back to 96, the NASDAQ was 1,000 and it peaked at 5,000. And that last doubling took place in the last year. So you could make the case that maybe we're not sitting here at the absolute peak if you want to go complete apples to apples. But And the valuations at the absolute peak were insane. I mean, Microsoft was, like I say, 80 plus times. Cisco was, over 150 times earnings. They were big, they were big businesses though. They were doing 20 billion each in sales. Intel was doing 30 billion in sales and it traded at 40 times earnings. Oracle was doing 10 billion in sales and it traded at 100 times earnings. A big difference today are at the top of the growth spectrum. You clearly have these 5 tech businesses. You have Visa and MasterCard that have 50% net profit margins. These are much bigger businesses today as a percentage of the economy. They are huge. I mean, the top 5 or 10 businesses made up a similar percentage of market cap then as they do today. They were differently oriented. It wasn't as tech heavy. Today, it's very tech heavy. It's very, to your point, kind of a lot of this incremental growth has come without the need for a lot of capital. But you're sitting here today with these big, now big businesses. I mean, large bases from which to grow. Microsoft doing 150 billion in sales. Apple's going to probably do $300 billion next year. Amazon doing over 300 billion. Google's doing over 150 billion dollars. As a group, they're now trading at 45 times earnings. And I would argue for the better part of the last decade, as a group and individually, these big businesses were not that expensive. In retrospect, MasterCard and Visa, when they traded in the low 20s to earnings, are not that expensive. If you overlay, as I mentioned, interest rates, and if we're going to capitalize things on a Fed model basis, I mean, we're no longer at 7% interest rates where you'd pay 14 times. We're not even at 5% interest rates where you'd pay 20 times. Now we're getting into this era where we're trying to justify valuations based on 150 basis point or 130 basis point long bond. And so you start talking about 60 or 70 to earnings. The flip side there is I think a large reason why we have zero interest rates and very low long-term rates is we don't have a lot of growth in the economy. For the last 20 years, nominal GDP grew 3.5%. For the last 10 years, it's only grown 3%. I would envision very little growth in nominal output for the broad economy. And so you have this kind of haves and have-nots, and we're very much rewarding the haves. But to what price? And you go back to the classic, finance study, and where's the equity risk premium? If you're paying 50 times earnings and a 2% earnings yield, where's the 4-point spread to credit-bearing instruments? I mean, I think you've got a Fed that's willing to say, we're going to hold short-term rates at 0. We're going to try to get inflation at 2. So we're going to screw the household saver to no end. Typically over the course of time, T-bills would kind of mimic the inflation rate. So now we're going to create, a 2-point spread there, and we're going to rob the populace that way. To me, it's dangerous. I mean, you think about where we've come in the last 20 years. The NASDAQ, which, as I say, went from 1,000 to 5,000, round trip back to 1,000. The S&P and the Dow fell by half. The NASDAQ fell by 80%. It completely gave up that 5 years worth of gains. And it took 15 years to get back to the peak. Are we at the peak today? I don't know. But since then, GDP is up by a little over twice, call it 2.2 times, from 10 to what was going to be 22 trillion, probably only 20 trillion this year. But, the the S&P was 1,500. It's over 3,000. So the NASDAQ, which was 5,000, is now yesterday 12,000. So, these things have all grown about 2.2x. And so on that same plane, you have these indices that are trading kind of on par with where GDP was at the time. And I put it all together, and to me, the lunacy in some of these names is as striking. And I'll stop here, but I think that, you take the businesses that are clear frauds or could be frauds, or businesses that are just ridiculously overvalued. Wirecard and Luckin, which I talked about with Starbucks. Tesla, at a market cap a few days ago, $450 billion on $26 billion in revenues, and really not generating profits if you look at the accounting properly. No. These SaaS businesses, who knows, but you're paying incredible premiums for everything that has to go right. We talked about that a few weeks ago. So I don't know. I never thought we'd see a repeat of the late 90s again. And it feels so much like the late 90s again, with the bifurcation in the market and valuation extremes that you're seeing, credit levels that are so much higher than they were then. I mean, I kind of think we're at the fork in the road where the outcome on the one hand is really bad, which is a deflationary period for the next decade. And the outcome on the other hand is really bad, which is the Fed and other central banks trying to introduce hyperinflation. And I don't see how you can have a normal road where we're simply going to grow nominal output at a reasonable rate, and we're all going to just kumbaya go along and make reasonable returns because prices are stretched beyond fundamentals. And we've got a wildly distorted credit picture that I'm not sure the central banks can extricate themselves from. And so
I want to present something like a little, maybe add two more contrasts with then, and perhaps come back to some of these questions, because I think they're really good ones and I think it's interesting. So one contrast that was from my list I didn't get to, but I think ties into exactly what you're saying, though, and you'll see how I bring it there. When you look at 1999 and really a parallel bubble that popped in 2001, the telecom bubble, from, I think I might be slightly off of my numbers because pulling this together kind of late, but from 1996 to 2001, there was $500 billion invested in U.S. Telecommunications infrastructure, which is just an absolutely obscene amount. And so in parallel with rising valuations, you also had massive amounts of actual investment. And this was malinvestment. There wasn't really need for that sort of capacity. And it had ripple effects through the system. So it made other companies appear, like Cisco in particular, looked like a phenomenal grower because as telcos invested all this money, they just had to buy a lot from Cisco. Today, you're not really getting that sort of feedback into capital expenditures. And so alongside that, in 1999, you had this incredible optimism at the turn of the millennium. The Cold War had been decisively won. We could move forward as a unified world with the American way. And today you have this kind of like retrenchment globally. And basically, I feel like societal, enthusiasm's given way to like mass anger. And you have no parallel boom in investment in any one sector in our economy. So when you think about the consequence of rising equity price, in some ways, perhaps the true effect is that it actually is incentivizing people to invest, right? Look at these massive prices. So start investing, build things on the ground up. Like before, your incentive was these things are really lean on capital. They don't need capital. So hell, I'll just buy them. But today it's like, okay, now I can't just buy them because they're really expensive. So I should invest in something to go beneath them or to go beyond them. And so perhaps, this could actually add fuel to the economy to actually get people to go back to more robust CapEx, to get capital expenditures back, as a percent of GDP back above the 30%, mid 30% range. It oscillated around from the 1950s to the mid 1990s. For context, since the fallout of the financial crisis, we've been sitting in the mid 20s for the most part. So, I mean, how do you think about that?
I think there's a lot to that. I mean, you had the communications world, which did peak a little bit later, and there was a rolling top to when the stock market peaked. It wasn't all March 10 of 2000. Parts of it peaked in late 2000. Parts of it didn't peak until 2001. But I remember the fiber optic networks that were being laid. One of the very most expensive mistakes that I made was trying to buy Williams Communications after the stock fell 90% in price, and the company had spent something like $7 billion laying fiber next to its pipeline network, and everybody was doing the same thing. And you did the math and thought you're never going to get there. I'd step back and make the argument as a counterpoint, Elliot. If we're genuinely going to replace the carbon footprint, and we're going to do away with coal-fired plants, and we're going to do away with natural gas-fired plants, and we're going to replace the internal combustion engine with battery, you look at the dollar cost of replacing the infrastructure that we already have in place, and it gets into the multiple trillions of dollars. And again, we're at a level of credit market debt that's now 4 times the size of output. We don't have the money to take on these these infrastructure projects. And we don't generate the free cash and the incremental profitability. There are capital-intensive places. Tesla, we talked about it a few weeks ago, is an incredibly capital-intensive business that's going to need money to grow. And raising $5 billion here off on a stock that's trading at least 10x above what valuation would normally warrant, I just don't think we have the resources. And so, perhaps it's not directly being spent within the companies, but you have a lot of fanciful valuations in a place like that. in the battery cars, the battery technology, where prices are so far ahead of reality. And again, I'm not sure we have the money to do what we're setting out to do. And so there are going to be a lot of explosion of capital in that place. And there are, to me, pockets of parallels between the two periods.
Yeah, I agree with the pockets. I guess with Tesla, so are you basically saying that the $5 billion they're raising now, which, by the way, I feel like they should have raised money a lot sooner and taken that off the table, but, power to Musk for having waited out markets here. But do you think that should have been invested elsewhere and we're getting malinvestment there? And in aggregate, do you see anything where at this scale, we're investing too far today? Like a bubble typically comes with a high degree of actual malinvestment, I would think, or, guess, but I just don't feel that there's one area of massive excess in the end dollars being spent, more so just multiples in some pockets. You know what I mean?
Yeah, I just think if we're going to spend 25 to 50% of GDP replacing the energy grid and the way we produce power, and maybe we have to get there, I don't know, but we don't have the resources to do it. Tesla, the $5 billion, I don't know if you guys follow what they did, but that was an at-the-money transaction, or it was at the market. So they're not going to take a roadshow and pitch a $5 billion capital raise to anybody that's got a brain on their shoulders. They're going through this army of brokers, and they're going to sell $5 billion worth of stock, again, at a $450 billion cap, or what was a $450 billion cap a few days ago, to people willing to pay that for a business that does $26 billion in revenues and loses money and really pushes on the accounting envelope. Buyer beware, but I think it's just it's the absolute bad behavior of capital. If you're Elon Musk, you need capital to grow. They don't generate free cash profit to invest and grow the number of plants from 4 to 40 like they're going to have to do. So they're going to have to raise money. And why wouldn't you raise it when the share price is high? Well, Warren Buffett would never raise the price and fool a shareholder in a new buying round at a price that was just absolutely lethal to your capital. I think it's very plausible that Tesla trades 80 to 90% below the current bid. And the only way they're going to grow is to raise money. I think what they've just done is abhorrent. But again, it goes back to this battery technology. Maybe we have to get there, but the winner is more apt to be Volkswagen and Fiat Chrysler and GM, companies that already have the infrastructure in place. Do we have to replace the energy grid? Do we have to replace the auto manufacturers with something entirely new? Again, I don't think we have the money in society to do what we're setting out to do. And we're talking about enormous capital expenditures.
Yeah, but at the same time, we haven't really gotten to a point where much has been invested. Like Tesla, in the grand scheme of things, is just like a really small speck. This might be the first whiff that there's something beyond that degree of investment. So that's where I have a hard time grappling with this. I just don't see massive societal overinvestment in any one thing other than valuations lifting.
Well, within Berkshire Hathaway, they're spending a mountain of money on CapEx, building out their wind and solar infrastructure. And they're doing it on an allowed rates of return basis. But it's a subsidized spend. The tax credits that they're earning, justify the capital cost of the project. If you didn't have a societal directive that this is where we're going to go with energy production, the investments that Berkshire's making would not make any sense. You would lean on natural gas. You would lean on coal. I think it's insane for the globe to go away from nuclear energy post-Fukushima. And the trillions and trillions of dollars that we're going to spend, which are going to be done in solar and wind, if you think about it, the amount of capacity you've got to create winds up being double current productive capacity, because the sun only shines half the time and the wind doesn't blow all the time. And for the time being, you can't store it. It's just, the numbers, if you really dig into the science, are gargantuan. And again, we're broke. The United States is broke. Europe is broke. Japan is broke. I don't think we can afford to do what we're doing, which, is done with the noblest of intents. I'm very skeptical, and I disagree. I think the numbers being spent on alternative energy are very, very large numbers. I don't know, Phil or John, do you guys have a
I guess I'll jump in real quick. I don't think Berkshire Hathaway would, malinvest a CapEx. So I don't think that's, any sign of a bubble in capex and malinvestment. And I'm not sure you really need that kind of malinvestment to actually happen for it to be a major bubble. Back in 2000, we did have the telecom bubble, and it did involve a lot of capex. But now the nature of the companies that are kind of leading this, other than Tesla, are just companies that don't need a lot of capital. And so you could say we're not really destroying actual capex through malinvestment, although on the alternative energy side, I haven't looked at the numbers. It could very well be the case. But what is happening is that you're having a huge wealth transfer potentially from company founders and VCs and insiders that have kind of started these call it SaaS companies, just as a catch-all, to those insiders and VCs from your average Americans who are the retail investor that are paying 50 times revenue for some of these companies now. And so you're not destroying capital in that sense, but you are having a wealth transfer in the exact direction in which wealth inequality has been going already. And we'll just have to see what broader ramifications that might have. But just psychologically, it feels like some parts of the market are ridiculously frothy. And so, trying to understand it rationally, I don't know that it even makes sense in some cases. Like Tesla, you could say they have a great future ahead. Things are moving to EV, but you got to somehow link that to the price you're paying and the valuation that's implied. And the bull cases that I've seen, it's very hard to link it to anything that makes sense on the numbers side.
Yeah, that's exactly right. The prices, when you're paying 40 times or 45 times or 50 times for very, very big businesses, I'm not sure where the growth comes from. That tech sector, Microsoft, which has grown from 20 billion in sales to 150, had a long runway to grow at a very high rate. How do you grow that business from 150? Well, you talk about the total addressable market in the cloud, which is a huge number. At some point, you play around with the numbers, and all of a sudden, 100% of total U.S. profitability for the S&P 500 is inuring for the benefit of a handful of businesses. And I think, something's got to give in the meantime. The real problem is you pay 45 times for that group of 5 companies, or you pay 50 times for Visa and MasterCard. You're looking at 2 to 2.5% earnings yields. To your point, John, you've robbed your future return. And if you're in a world where you think you're going to make 10% returns, which has been the average for the broad stock market back to the 1920s, when you look at returns through a very long-term lens, maybe you shouldn't expect that much in a world of zero interest rates, but at 2.5% earnings yields, there's very little margin for error. And that would not have been the case 4 or 5 years ago. That would not have been the case with the companies that made up the NASDAQ in 96 or 97. They were expensive, but they weren't nosebleed crazy. At the peak, when the NASDAQ traded at 5,000 and the market cap of $6.5 or $7 trillion was almost as great as the New York Stock Exchange, that was insanity. And you didn't get back to even for 15 years. I don't know that 15 years is the right number, but I would bet you that if we have this conversation, or when we have this conversation 15 years down the road, that we have robbed, by paying the premiums that we're paying for a lot of these growth businesses, you have robbed so much return that at best you're flat for somewhere between 5 years to 10 years, and in some cases 15 years. You pay $120 billion for Shopify doing $2 billion in sales. How long does it take to grow into the valuation? And in the meantime, what can go wrong? Where's the disruption at the next iteration of business cycle? I just think, man alive, you're everything is priced where it has to go right. And the last time I peered through the lens of just the broad, markets, the last time everything was priced for perfection and then some was the late 1990s. And, it wound up being a really bad experience for those that were willing to play the game up to the bitter end.
Yeah, for a little bit, I've been saying this. The path from 40 times price to sales to 40 times PE is a bumpy one, because inevitably that's where all these growth companies are going to start having to justify what they're capable of. And now the bar's been raised on the price to sales side. But one of the interesting things to think about again on this contrasting things now, I mean, obviously Buffett owned Coke and thought about the valuation there, but today he owns Apple, which I think most recently is one of the hallmarks of things getting a little too far ahead of themselves, maybe up there in a league with some of the price to sales stories. So, it's definitely interesting to think about. I wanted to make sure before we moved on from 99, and, I know you guys might have a little more to say, but to call out a book that I think is phenomenal and really helped me think about some of the past trends and build some of the contrasts. Bull, A History of the Boom and Bust, 1982 to 2004 by Maggie Mahar. It's really phenomenal, really excellent read. Reads like a novel. It's kind of fun, and a lot of names that you'll see today in a different light. So I definitely recommend that. And
that is a great book. I agree.
Yeah. I love that book. And just maybe one point on Apple, and Chris, this goes to your point on some of these businesses just being so huge that it's hard to see how they keep up those growth rates. And with Apple, this is a company that's now valued at 7 to 8 times sales. And even that, I guess, relatively low level of sales compared to what it will have to be to justify the current valuation, even at this level of sales of like under 300 billion, there is huge resistance to Apple in the industry because of their App Store take and just their strong arm tactics. So, I mean, where's another billion in sales going to come from when already, powerful developers and so forth are pushing back very hard? And the only reason why this hasn't broken yet is that it really is a monopoly. But something's going to have to give, and I just don't see how Apple's going to grow sales to $1 trillion and beyond, given what's already happening in terms of how their sales are coming together today.
Yeah, I think the Coke comparison is a great one, John. You go back to 98, and Coke was 45% of the stock portfolio within the insurance business. The insurance businesses collectively were worth most of Berkshire Hathaway at the time. They hadn't made material investments in energy and in the railroad. At that point, they hadn't bought a lot of the subsidiaries. And here you are with Apple at $2.2 trillion market cap, $300 billion in sales, $60 billion in profits. Berkshire owns somewhere around 6% of it. It's half the stock portfolio again. It's just like Coca-Cola was. And since then, the Gen Re transaction wound up to be brilliant, and it allowed Berkshire to diversify away from Coca-Cola. But in the subsequent years, Mr. Buffett said, one of my biggest mistakes was not selling Coca-Cola. I can tell you, as big as our position is in Berkshire Hathaway, my prayer time at night when I get down on my knees at my bedside is now directly, exclusively directed toward, I pray, Omaha is selling down the Apple position. That's all I've got to say about that.
Yeah, Apple confounds me, but I think it also, I guess I could talk about Apple a lot on these sorts of things. It confounds me too, insofar as like Google has a better growth profile for the next 2 to 3 years and is trading at lower multiples on earnings and price to sales than Apple. So it's like, there's something uniquely special about where it is right now as maybe a pool of liquidity in contrast to a company in stock or as a name or whatever it may be. But I'm with you there. I mean, I definitely, I would think the Coke lesson applies here, and you kind of feed the market gods at least something into this. You could, one of the interesting contrasts too for Coke with Berkshire back then versus now, Coke would have been a little harder to sell. Apple, like I spoke about this, I can't remember which of our podcasts, but 3 days of average volume would let Berkshire exit entirely. And that's pretty freaking unique. It's a massive position, but you could really just kind of hit a button and say goodbye like that.
All right, well, let's move on to our third topic of the day. Phil, you have something interesting prepared for us. We are all ears.
Sure. Thanks, John. So hopefully you guys have had a chance to look at this. What I thought I'd do and see how it works in an audio format here is what I call a blind valuation, which as far as I know was first done by Ben Graham all those years ago as a teaching tool. And it's one of the best teaching tools and thought experiments I've ever come across. So I do this in the MBA class that I teach. And I do it just on my own time. I'm a lot of fun at cocktail parties and whatnot. It's a fun way to kind of play almost a riddle and get people's opinion on things without allowing the narrative and the psychology of the individual company to come into play at first. I think a lot of us probably do this, or if not, it's a great practice to take a look at something and try to value it without knowing what the market price is in advance. And this is kind of a take on this where you have the financials and kind of the profile of the company in front of you, but you don't know what the company is, and you're coming up with what you might pay for it in a broad range. So I sent this over to Chris and Elliot and John, and I'll describe the two companies now. They're both based in the U.S., headquartered, domiciled, traded, publicly listed. They've both been around for quite a while. They're both in, for the most part, functionally identical industries, which technically is classified as specialty stores. When we identify them at the end of this, that'll become more clear. In the case of Company A versus Company B, I think the most salient difference is sales growth. This gets back to what we were talking about earlier in terms of what people are willing to pay for revenue growth right now. So Company A is trading, we'll call it, we'll just use round numbers, about 20 billion of sales. And that number is basically dead flat over the past 5 or 6 years. That number should be flat to down slightly this year compared to 2019, but quite profitable. Mid-single digit operating margins, tons and tons of free cash flow. I mean, averaging anywhere from $750 million to $1 billion of free cash flow on that $20 billion of sales. Quite good returns on equity because they've been quite prudent with their balance sheet, in the 15 to 20% range. A little bit of net debt on the balance sheet, certainly $4 or $5 billion in net debt. And what's interesting is they've actually been plowing back a lot of their free cash flow into repurchasing shares. So the share count has fallen quite a bit over the recent 4 or 5 years. Where you contrast that to Company B, where the sales growth has just absolutely exploded, gone from a few $100 million a few years ago, 5 or 6 years ago, to now potentially $5 billion or more this year. But what's interesting is those sales have exploded. Not only are margins still negative, but in a lot of ways they're not really looking like they're going to turn the corner anytime soon. And because the company is quite capital intensive as well, the free cash flow gap, the negativity of the free cash flow is accelerating. And likewise, the financing need has continued to increase over the years. There's a dual class share structure here. The shares outstanding have almost quintupled over this period of time, and the debt has gone from basically zero to well over $1.5 billion at this point now. So, guys, I don't know if you have the numbers in front of you. It'd obviously be far easier for you to do this than anyone listening out there. We can put the blank financials out in the show notes, or I'll put it up on Twitter or something, and people can look at exactly what you guys are seeing right now. But does anybody want to be the guinea pig and kind of throw out their observations on this, or what they might put as a kind of rough range evaluation on the companies?
Phil, I think I figured it out.
Okay, that's even better. If you know exactly what the companies are, that would be impressive. And again, this doesn't, by the way, I should have said, I did use the real numbers a lot of times because students can be enterprising people. I will change the numbers by shaving a decimal here or there or something. But if you actually looked up the numbers or just reverse search the numbers, you could figure out exactly what these companies are. So if you did that, please recuse yourself. But otherwise, if you know what the two companies are, that would be great.
No, actually, I'm not entirely sure. I'm almost sure the one you put on the right. I'm pretty sure I know what that is, and I could guess at the other one just based on the size of the business and the margin structure. But you go through the financial. I think this is great. I did this in one of my client letters with the trucking business that Berkshire bought from Walmart a few years ago to kind of demonstrate what really mattered in investing was return on capital. And you could take a business with really low operating and profit margins, and as long as the capital invested in the business was sufficiently low relative to sales, you could generate a good return. And so Phil's example here are a couple businesses that have, well, in the case of your Company B, negative operating margins, explosive revenue growth, actually accelerating losses. You didn't put in the share count, but my first question would have been, how dilutive has this thing been in terms of number of shares to finance the growth? Because it's clearly bleeding cash for the time being. But you look
that's actually in my spreadsheet. I should have, but it's the share count. It's the dual share class, which is what's interesting as well. The publicly traded share count has gone from 15 million in 2015, 16, 17 to almost 70 million. So like I said, 4 or 5x over the past 4 or 5 years. And meanwhile, the The B shares, which are owned by the controlling shareholders, has actually declined slightly over that period. But the total dilution is obviously still staggering to the public shareholders.
And it appears there's no acquisitions in the story. It's just pure investment business.
Yeah.
Which would be another question. Yeah, I think.
Yeah, that's correct.
Phil, I look at your company A with what would have been very consistent, kind of 4% operating margins, net margins less than that, and you've only got a handful of industries that would jump out. Some kind of distributor, a retailer like a grocer, something on the order of that. And so that's the first place you go. Both business are not very, are not, at least with the figures here, are not very asset intensive. So your company A generating what had been about $21 billion in revenues on total assets of about $10 billion. So at 2 for 1, a couple billion in intangibles. So there, to your point, Elliot, you would not see a lot of growth because that intangibles number hasn't grown at all. Company B hasn't made any acquisitions. You've put no intangibles on the books. Returns on equity are really good, kind of mid to high teens for company A. I've spent 30 years with the value line pages looking at just the numbers in the boxes. And so, my eye goes toward progression of revenues, progression of the various margin structures, the capital structure. And so, you very quickly, without knowing what the business is, can kind of weed down, kind of drill down to any number of businesses. So only because I looked at Carvana late last year, my wife was going over, they were talking about putting in one of their elevators, about a driver or a 3-wood away from our house. They put those elevators in, where they deliver their cars with a coin in kind of light industrial areas off a freeway, and they're really billboards. So I looked at this thing, and the dilution from share count. I think these are both auto retailers, and so I would guess, based on the figures, that Carvana is the one on the right, and I don't know. I'd throw out a Penske on the left, but it could be any other auto guys. I could be totally off. I mean, the growth on company B could easily be a SaaS software company, kind of financing its growth, but you don't see the incremental drive on
no gross profit margin too. So
on the gross margin wouldn't even be near as high as the softwares.
The gross margins, for context, were negative in 2015, and they are in 2020 showing about 13% gross profit margin.
Because they're in the same industry, you eliminate software because the gross margins on company A were kind of in the kind of mid-teens level, where your softwares are going to be north of 50 generally.
Yeah. And company A looks like they did make an acquisition early in the period to give them like 1.2 billion in revenue on 300 million in growth and intangibles. And they've since lost all that incremental revenue. But it doesn't appear like extremely cyclical. From 2016 through 2019, it was basically flat revenue with no new growth in intangibles. And I mean, I know off the top of my head, the auto cycle had peaked at that time, though it didn't really like drop precipitously, but perhaps that might have come in. I don't know. Maybe a dealer might have had that. And I'm really stuck on the margins of company B, though. Like, you would think if you add an extra 5.1 billion in sales and you have some high degree of fixed cost embedded in your COGS, you'd scale gross profit margins far more than they have, and it's just not showing up. I think instead of trying to guess the companies, I was trying to think what I'd pay for each of these companies respectively.
Yeah, that's also a good way of doing this. That's a great part of the exercise. Yeah.
And so, I mean, like on A, I got stuck on, they made an acquisition and they've since eroded all that incremental sales from that. They have like, I don't know, their EBIT to gross, like I was thinking similarly to Chris, that there's something like distributor-like to this, but their EBIT to gross isn't, otherworldly. So there's not that much, it's kind of like straddles the line between it is and it isn't distributor-like. Cash flow's been pretty nice. It actually got better as sales came in. So that's something interesting. So they could wind down a little bit of their, but it doesn't look like they drew down their working capital considerably. So, when I think about what I'd want to pay for this, like it looks like on the low end, they did 630 million of NOPAT in 2018. On the high end, they came into this period in 2015 with, 740 million of NOPAT. I mean, maybe I'd pay something like 5 to 7 times on the high end, but I'd prefer to pay it off a lower period if it is cyclical. I mean, there's definitely some kind of cyclicality in there. Company B is one of those things I would totally need to know more, like the composition of within their OPEX, and they don't have much room from their gross profitability to support their OPEX. Like, to what extent are they investing in marketing or R&D? Like, is there something unique to their business that they're investing in there? Like, do they have a unique sales culture and go-to-market strategy on the sales side, or do they have some like intellectual property that their R&D has been a big source of investment, but like they could really start scaling, especially the OPEX, considering there's not much scale available in their gross profitability. Saying a number I'd pay for this business is like almost impossible. It's hard to think I'd pay a penny above their total assets. So like $3 billion for $5.2 billion of sales. So I'm going to stick with $3 billion. I didn't give a number for company A, but like, let's say, so what did I say? I said like 5 to 7 times their NOPAT. Call it like $3.5 to $4 billion for that company.
Yeah, I would say, with B, given the cash burn, not unlike a biotech, if you've got a business that achieves scale at some point, you got to figure out where you kind of reach normal maturity and a normal margin structure. And so if you're running, negative operating margins of still 7%, admittedly better than the 27% you show for 2015, there's no level of free cash profitability. I assume all of this working capital has come from the equity raises you talked about. They've taken on, a fair amount of debt. Net debt is $1.2 billion. So the company's, equity of 620 million. You don't break out the equity number. So the retained earnings have got to be a big negative number over the life of the firm. So they've still not generating cash. To me, you've got to say on the $5 billion number, how much more capital does it take to get to some level of profitability, and then figure out what the margin structure is. If you believe that this is going to grow into, maybe a margin structure of a company A, since you put these businesses in the same industry, trying to value company A initially makes more sense. So if you've got a 4% operating margin business, let's say these net income numbers, 2020 is clearly hit by the COVID. But if you take that 451 million net and 600 earnings before tax in 19, those numbers really have not grown for the prior 5 years. Very little growth in this business. If you had a growing business that did a 2% net margin business and a 4 operating margin business, I would pay a third of sales for that business. So on 2019 revenues of 21 billion, sales would be, sales down by, looks like 10 or 15%. That's the COVID. You might pay, or you might value this thing at 7 billion, and I would pay, 70% of that. So I wouldn't pay much more than $4 or $5 billion for this one. That's slight premium to equity of $3 billion. They earn what have been kind of mid-teens returns. So, if you've got a growing business, you'd pay 3 times equity for a growing business, but you don't see a lot of growth here. But again, you don't know if they've divested any subsidiaries, if they've sold some businesses. You'd have to know a lot more about the color behind why that sales number growth is stagnant. If it really is an auto retailer and you're coming off peak SAR 3 or 4 years ago, well, that would explain the flat top line, simply because unit sales in the industry have been in decline for a couple, 3 years. So I'd back into a valuation on B. I tend to not own businesses that are not generating free cash, so I'd have a problem with this. I bet you if it's Carvana, it's trading at some stupid number like $100 billion or $50 billion, kind of 10 to 20 times sales. And TBD on whether you've got a scalable business here. I know they talk about advantages of not having as much money tied up in land and working capital. But I don't know. I mean, if you follow the business model, if it really is Carvana, wasting a lot of airspace here if I'm totally off on the industry. You can take the car and drive it for 2 weeks and then send it back. I don't know. I wonder if this is a legit business with real scale or if the accounting is pretty aggressive. I know the guy that started Carvana was a convicted felon, or the father of the guy that started it was a convicted felon. So, if you own B, Phil, I feel bad if I'm wrong if it's Carvana. But I've looked at it and I wonder if. But that's the approach. Is what drives the top line? Is the margin structure normalized at these levels, or is it aberrantly depressed or overstated? So a lot remains to be seen with some of the granular data. But yeah, I'd go with I think Elliot's you're roughly on. You pay $4 or $5 billion for a little premium to equity and about a third of sales, 20% to 33% of sales, let's say, and B is totally depends on the scale. If it's really going to be profitable like this, you look out 5 years. Let's say the thing's doing $20 billion in revenues, kind of 4x today. If it's doing a 2% net margin on $10 billion in sales, you pay. Given the growth, you might pay half a sales for it. Costco, a business that does a 2.2% net margin today, for the first time in its history, I think as of yesterday, traded at 100% of sales. They do a 2% margin. It's a lean margin business, and despite the growth and the high returns on capital, the stock in its entire history has never traded at 100% of sales. The businesses that comprise the industry you've got presented here, or follow a similar margin structure, similar level of capital and asset intensity. And so I wouldn't pay a big premium to sales, but I bet because you're in this 1999 new era, I bet you B trades for a big fancy multiple. And if it is a SaaS company, which it probably isn't, then it would trade at 20 times sales or 30 times sales.
John, do you want to weigh in, or do you want
I'll weigh in quickly. On Company A, I'm kind of with the guys. I looked at the FCF to kind of give me a yardstick for the valuation. It's averaged around, I guess, 900 million or so over the last 4 years, but net income has been a lot lower, around 400 million. So, and just given that there isn't any growth in that business or kind of flatlined sales, I'd imagine that FCF would have to start converging with the net income number. So that's probably going to come down. And they do have $4.5 billion of net debt. So, I'd probably look at this company at 1x book value, maybe a little bit more, so also in that $4 or so billion range on the equity there. Company B, I honestly can't do anything with because that business is worthless to me just on the numbers themselves. I mean, if I owned this company, I'd be bankrupt. So, they must have a great story that's allowed them to finance their growth with apparently with debt. I mean, their debt has gone from 85 million in 2015 to 1.7 billion in 2020. And despite using so much debt, Phil, you mentioned that their shares outstanding have also quadrupled.
It does, yeah. You can see it in the book value, but I should have put the share count. It's a row of the spreadsheet that's hidden from you guys. I should have put it in there. But yeah, there have been equity issuances consistently
they've clearly been very good at telling their story and raising capital. So, kudos to the insiders for that. Wouldn't surprise me if they've sold some stock along the way. The one positive thing about Company B, besides the top line growth, is the operating margin loss or negative number has come down over time, although it seems to be flat from 2019 to 2020 at about minus 7% operating margin. But presumably that's going to keep coming down, and at some point this company turns profitable. But for me, it's very, very difficult to put any kind of valuation on that business.
Phil, I have a question for you.
Sure.
And I'm hedging. I'm hedging now my prediction, but I'm just orienting myself to your data. Present value of operating leases, is that the capitalized value of 1 year's operating number?
Either my estimate of the present value of 1 year operate, or if it's disclosed now. Yeah. So again, it varies over time, but
So the rent number is the $12 million in 2020 rent for company B and the $50 million for company
correct.
A. That is not the 1 year's operating lease expense. That's just actual rent.
That's actual rent expense, right?
So my comment here is, if these are indeed auto retailers, either they must own outright a bunch of the land, which you would see in the asset and the debt number, or they're just or they're not using a lot of operating leases, because I would think that the land, if it were leased, would be, I think your operating lease numbers in both cases would be much larger numbers. That's something that gives me a little bit of pause.
I think the big takeaway here is that you guys are too good, and I should have known to not play this game with ringers. It's much different when you play this with first and second year MBA students who haven't done this for a living for many decades. But let me jump into the big reveal with a quick preamble, which is that I don't own either one of these. I'm not short anything, let alone I'm not short either one of these. I generally strongly prefer to criticize by category rather than by name, so no one should take any criticism of either of these too personally. By no means is this any sort of recommendation, long or short. Either way, for heaven's sake, this is academic and for illustrative purposes only. I mean, it's just meant to show the compare and contrast aspect of this, because both companies are somewhat similar and they're very different in some ways that pertain to what we've been talking about a lot. So with that in mind, and another hilarious wrinkle to this whole thing is that I actually went to high school with the CEO of Company B. I didn't know him well. I doubt he remembers me. I can guarantee you he doesn't care what I have to say or think, but I certainly don't wish ill upon either Company A or Company B, that's for sure. And like I said, I don't have a dog in the fight either way. This is purely for academic and debate purposes. So funny enough, Chris is exactly dead spot on. Company B is in fact Carvana. So I think if there's no other takeaway other than that, it's to show you how good somebody like Chris could be at handicapping this sort of thing, and the breadth of his knowledge and how he can zero in on this sort of game is that was extremely impressive. So well done. I'll have to send you a Starbucks gift card or something as your parting gift, because that's very impressive. And I mean, the things that jump out to you are exactly what you guys laid out. So I will not belabor that point as well. I will say that as you compare and contrast, though, the board structure, the capital allocation, the overall governance, this company has some very smart, high-profile investors that have obviously done extremely well. And it is very interesting to me as I've talked with them and debated with them about the virtues and merits of this company over the years. Very few of them seem to really care or focus about that. It's really just about the narrative and the top line growth, which of course has its merits. But you talk about the dual class structure. You talk about actually the parallel private company and drive time. Most of them don't seem to even care or be aware of it. The prospectus here is fascinating reading. Most of them have never heard of Ugly Duckling, which was the predecessor entity in a lot of ways to this company. So it's just really fascinating. And then the reason I picked Company A, which is not CarMax, which would be potentially a more direct competitor and would make the same point in a lot of ways. But the reason I picked Company A, which is AutoNation, which is that for many, many years, many decades, it was actually the polar opposite from an allocation and a governance perspective. Mike Jackson really came at this from a Will Thorndike outsiders kind of mentality. He had Mike Larson from Cascade and Eddie Lampert on the board for many years and really put on a master class in governance and capital allocation for a long time. And you can see those results here. And so I think the difference is exactly what John said, which is it's not about, to me at least, which company would you like to own in the public markets. It's about which company would you own if you owned the entire thing. And so if you owned the entire thing and could not sell into the secondary market, which, by the way, there were about $180 million of insider sales in this company last week alone at Carvana. That was just named directors and officers. But if you had to own just this entire Company A or Company B and basically live off of the value of that company for the next 10, 20, 30 years, in effect, live off of the cash flow and the dividends that it could generate, that's a totally different debate than the beauty contest debate of which company is sexier and which company is growing and which company can kind of sell its story on to Wall Street, so to speak, because that's obviously been met with enormous success. So the values that you guys generated, this was actually as of yesterday before the big sell-off today. So the market cap of AutoNation was a little over $5 billion. You guys kind of guessed in the $3 to $4 to $5 billion range. So you really weren't that far off. And you caveated your guess on Carvana that it was either too hard or or that it was going to be at some crazy level. But yeah, I mean, coming into yesterday, the market cap was pushing 40 billion, 40, so about 8 times higher than AutoNation, despite the obviously glaring differences in size and profitability. And the other interesting thing that I'd point out before I'll leave it there in the interest of brevity is just that one of the appealing narratives I think about a lot of these so-called digital companies is that they don't require the tangible assets to grow. And in many cases, that's true. But when you get kind of late cycle into some of those narratives, you see that thesis kind of drift. And what I think is so interesting here is that, one, I mean, just about anybody can replicate those strategies. It's more about executing on them, in my opinion. And two is that if you look just, for example, at these companies, CarMax actually generates about $2.4 of sales per dollar of tangible assets. Carvana is only about $1.80. It's actually less, like more capital intensive from a tangible asset perspective. And again, like if you look at just on enterprise value to sales, I mean, it's obviously off the charts, right? I mean, CarMax is a little under 2 times. Carvana is 8, 9, 10 times, depending on what you think this year's sales will be and going forward. And AutoNation's even lower at like about a half a turn of sales. So it's all about, how confident are you? I mean, if Carvana can continue to put up this explosive sales growth and you wake up a few years from now and instead of $5 billion of sales, it's at 10, 20, 30, 40, 50 billion of sales, that's a whole different story. And, they can potentially finance their way up to that number and maybe it'll work. But, that's a very different bet than a cash flow bet. So bravo to you guys. You did great. I thought that was really fascinating. And depending on the feedback we get, maybe we'll do another one down the road.
Well, bravo to you. I mean, if I could say one thing here, John, that is, Phil, I mean, doing this with students couldn't be a better exercise. It teaches you how to think first about the business and the numbers and very last about the price. I mean, if I could give one bit of advice to anybody starting an investment career or young in the profession, it would be not to make this a commercial for Valuation, but from day one when they plot me into the library at the bank trust company, and I had access to the Moody's manuals and the S&P manuals and the Valuation. I've made it a habit over 30 years of investing, going through the paper versions. I still get them in the mail of both the large cap and then the mid and the small cap version of the Valuation tear sheets, and I can't tell you how beneficial it is to just skim through and read through every one of those pages every week. You get 13 editions. So, once a quarter, you're updating your numbers. So, every time, you scroll through a new one, you're touching on an industry. You're touching on how industries are valued. And it becomes valuable at times when you start to get changes within an industry or you start to get changes in overall market valuation, to be grounded in the history of the numbers. I mean, I couldn't begin to value a business by looking at a snapshot of just 1 year or 2 years worth of financials. I couldn't be a venture capitalist. I'm not good at looking out 10 years. I couldn't do a Carvana 5 or 10 or 20 years out and figure out at what point does this thing scale into profitability, because I don't see it. My brain doesn't think that way. But to have these reference points of the data like you've laid out on the sheet, and I hope you put these, I hope, John, you can put this template online.
Yep.
But if you don't have Valuation, if you've got access to databases, I would make a habit of scrolling through as many businesses as you can, even in this kind of format. I'd add a few things like depreciation and CapEx. Those things are important to me. The number of shares outstanding, which we talked about. I'd want to see if there's a dividend policy or a payout ratio over time, and then a little bit more nuanced data on the components of working capital. Where are you inventory financed? Where are your receivables, your payables? But the data that Phil has on these 2 pages comparing these businesses, if you can get yourself oriented to linear data over time, I find it to be the most useful exercise that I've come up with over an entire investing career.
I agree. And that's, but I will say the pushback I most often get on this, because I'm fully in your camp. And so I have to force myself to argue the other side. The pushback I get, which is at least partially valid, is that if you're too grounded in the numbers, you kind of miss it. You miss the future or whatever, similar to my old professor who missed Starbucks by over-focusing on things. I mean, I've gone back and read old financials for great companies like Google at IPO or Alphabet, Amazon 20 years ago, Costco 20, or whatever the case may be. I mean, you can't overly anchor on where you've been, but I think the point remains that if you can look at these numbers and come up with a number that's off by an order of magnitude to the expensive side, then maybe you have a problem, right? So that I think is an absolutely valid practice and something everybody should do. And again, it's all about the magic of balancing the quantitative and the qualitative. And that's where I think it's so fascinating in a case like this. You just completely eliminate the qualitative, and you do that either first or second, but you do them both before you look at the price and try to bring them together and say, from a triangulation, does this make sense or is there something really off?
Yeah, I think the beauty about looking at linear data, the way that I do at least, is 4 times a year I've got to form an opinion about a business and an industry. And what you realize over time is if you are grounded, to your point, in the trailing data and you're grounded into what you think a normalized margin structure is, you make mistakes and you don't catch when an industry is changing. But when you force yourself to go back and reassess what you were thinking 3 and 4 and 5 years ago, how did Starbucks, for instance, drive its net profit margin from kind of mid-high single digits up to what's now 13%? How have they driven the returns on capital from mid-20s up to the 30s? So it's through that lens of looking at the numbers over time, both retrospectively and prospectively, that forces you to grow to an understanding of business valuation. Yeah.
And Phil, I think one advantage of doing it the way we just did, thanks to you, is that when you look at the numbers, just the pure numbers on Carvana, and then you find out its valuation, actually the exercise we did tells you how much you need to focus on the subjective and qualitative aspects.
That's right. Yeah, I think it's enormously helpful to kind of do it in reverse, right? Take any problem and flip it upside down. And what are the expectations baked into the current price? And are you that much more optimistic or bullish than the expectations that are already baked in? I totally agree.
Yep. Great. Well, we are going to make this available for download in the show notes. So maybe someone even wants to run this as an exercise at their Saturday night party or in a classroom. We would be delighted to have the podcast used in any educational fashion. Well, thank you guys so much. This was a great episode. Thanks also everyone for listening. We'll be right back with you next week. Goodbye now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.